Well, I think the U.S. fundamental economic data is holding up much better. So it is confounding to see 3.7% unemployment rate, new hiring very steady with a big domestic base. I think we have the advantage in this trade war scenario. Having said that, the Federal Reserve doesn't necessarily want to stay out of step with global central banks because that can strengthen the dollar too much. And in addition, the inverted yield curve is a fairly good, reliable forecaster of a recession, and you have the 5-year yield at about a 1.5. So that's inverted out to 5 years. So that is a little bit of a concern. So clearly, the rest of the U.S. Treasury curve is anticipating that the Fed is going to cut 2 or 3 more times this year.
So, Liz, currencies and bonds are in the driver's seat. What do you tell equity investors to do in that kind of environment?
Well, what's happened today, which I think is the rational thing, is that the S&P is still yielding more than the 10-year Treasury. So if I'm a rational investor and I don't think we're going to have a recession, which is where we stand, I don't think there's going to be a recession. The U.S. fundamental story is still holding up. You want a dividend yield that's going to pay more than a bond, and you have upside opportunity in stocks. So if we're not heading into the toilet here, stocks make a lot more sense.
Josh, are you specifically drawn to any dividend-yielding stocks? Or
I agree with everything Liz just said. And yes, I'm in Verizon. I've got a couple of REITs that I add to all the time. One is Store Capital. Another one is Invitation Homes. These are areas that really do not require the economy to be any better than it's been all this time. We're at 2% GDP growth. I'm not looking for companies that need 3% or 4% growth because it's not happening. And so think about Verizon as an example of that. And then when you look at some of the REITs I've mentioned, Invitation Homes is literally single-family rental homes. That is exactly what you want in an environment where 73 million millennials are forming households and don't have the down payment to go buy a $700,000 house, but they want to live that way. And so Invitation owns 80,000 of these homes all over the country, run by some of the most experienced private equity executives who have ever been involved in real estate. That's a great yield, growing yield, I would add, and that is the type of name that should work. And by the way, historically, I know everyone thinks gold is this great inflation hedge. Turns out it's not. REITs are the #1 inflation hedge over time. So that's like the type of thing that I think you can look at, and you're not putting your money to sleep. You're not saying, I'm going to accept 2% because that's the world we live in. No, let's find businesses that can thrive in the environment that Liz is describing. I think you can do that.
Liz, is there a level on the 10-year or any particular maturity of the Treasury yield curve, if we hit that you would think we don't act rationally, and it would make sense not to act rationally because it would spell recession or spell collapse?
There's 2 different ways I would answer that. The market watches the inversion at the 3-month 10-year, and that's certainly happened, and that's what puts fear into the market. The recession indicator is the 2-year 10-year, which hasn't happened yet. So the market is always going to get afraid if there's an inversion at all. What I would also watch is what we got to in 2016 was a 10-year at about 136. We could get there again. If we break through that and stay below it, that's when I think it's a little bit more of a negative signal.